computer. And we live, we live, we live. So blessings, 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 my beautiful human beings. Yours truly, Trainer One, coming right at you. So just wanna I'm gonna get straight to it. Not gonna waste no time with nobody, but I just want to just break down right the keys to help you um be a consistent, profitable trader. Simple. Uh, so there's a mindset that you need to develop, right? There's a mindset. There's many key factors of timing and management of your timing uh, will play a big factor into how you will pursue your trading journey. Um, so these are just a few things to just help you uh, as a mindset checklist. Trust everything you do to identify your setup, right? Trust everything you do to identify your setup. Trade only between the times of 7 to 10 a.m. and p.m. and also 1 to 4 a.m., right? 7 to 10 a.m. and p.m., 1 to 4 a.m. You want to have a pre-post trading routine, right? A pre-trading routine will consist of like you checking news, you catching up on the current events of what's going on in, or on whatever stock or whatever indexes or whatever currency you're trading. You have to, right? That's crucial because yeah, we are technical analysis traders, but we also are fundamental traders because the market is operated off of the economy, so we have to. So that's part of your pre-trading routine. Post-trading routine is you tracking all of your setups and you tracking, yeah, just you tracking your trades. Simple as that. Have passion for analyzing and getting better at your craft, right? You want to analyze more than you trade. The more that you analyze, the more that you can sit back and really have the market help help you sitting back so that way the market can help you see the bigger picture, right? Help you get better at what it is that you're looking at. Do not get excited about how much money you can make. Be excited about how many pips you can catch. Simple as that. Because if you don't know how many pips you can catch, then you don't know how much money you can make. The bigger picture is your best friend. Higher time frame analysis, right? Higher time frame analysis. So in the beginning, top down analysis, intraday trader, right? Identifying high probable targets and entry prices. Overview of how you can consistently profit, taking low risk, high reward trade setups. Past profits don't determine future results. We are not certified financial advisors or account managers. Trading is at your own risk. Where you determine your outcome, we're just here to help provide a higher perspective of how to minimize your losses. So, with that being said, right, the bigger picture is your best friend. Higher time frame analysis. We are practicing ourselves to be swing traders, right? But we're developing a swing trader mindset to be an intraday trader. Trading is 90% analyzing, 10% holding it down, right? If you analyze more than you trade, you can keep your emotions out of it. Simple as that, right? Trading is a transfer of wealth from the impatient to the patient. Buying and selling is the game. Risk management is the concept. Compounding is the goal. Scare money don't make money. So this is just what I use to just help keep me in a constant flow of just making sure that I'm following my plan. I'm following everything. I'm, waiting for my confirmations. I have multiple confirmations for me to take my trade, right? And I'm caught up on my current events to help me understand that news influences the market. So now going into account management, diversify my portfolio where I will look at 5 charts at a time, trade 3 at one time, and I'm looking at the other 2 just so I can find whatever other setups outside of the 3 setups that I'm already looking at, right? You do not want to stretch yourself too thin. So I highly suggest having at least 2 to 3 live trading accounts so that way you can, number one, not over leverage your accounts. Number two, have a wide range for you to trade more currencies or indexes or cryptos, right? we're only tracking high probability setups, targeting 50 plus pips, targeting 50 plus pips. Based on each setup, we can risk between 20 to 30 pips or 40 to 60 pips, depending on the volatility of that currency pair. If your stop loss gets hit, reevaluate your buys. Most of the times, the market is reversing. Take a total of 3 setups at a time, given a total of 6 open positions, meaning we're twin trading each setup. By twin trading, that allows us to have 2 entries each setup. Our first entry is a 50 pip target. Our second entry, we're holding that one with stop loss and profit, targeting 80 plus pips based off of the setup. Simple, right? We're twin trading. One entry is a 50 pip target. The second entry, we're holding with stop loss and profit, targeting 80 plus based off of the setup. This is a grabbing and going, holding and flowing concept to keep you consistently profitable, risk-free trading, right? Do not enter any more trades until 250 pip targets get hit. Why? That way it can help you save your margin, save capital, and manage your risk. Withdraw 30 to 40% of earnings per week or per day based off of your percentage gains, right? Pay yourself, live to fight another day. Right, live to fight another day. So now what I'm about to go over, the first thing I'm gonna do before I start breaking down anything is give you the terms and the blueprint to look for a setup. And then I will break down each one. I will be going over market structure tonight, but I will be giving out all of the confirmations that you will need. And throughout the week, I will break down each confirmation. It's very simple. It's really, really very simple. This system is very simple as long as you follow it and you stick to it to a T. Right? 1 second. Let me just crack the door because I'm about to get busy. I bet. I need some water. So yeah, like I was saying, we're about to get busy, right? I'm gonna give out all of the confirmations, right? The language that you need to look for, and then I will be right then. See, my AirPod just died. Hold on. I'm valid. You guys can hear me? Drop a 1 in the chat. Can y'all hear me? All right, bet. So real quick, right? For your chart breakdown, like I said, top-down analysis trader, we're looking to build a bias. Trading is about building a bias because the market is consistently moving. This market has been moving for years. That's why it has the time frames for us to look at them, for us to analyze it at, because it's telling the story. So if the market moving every single second, then we have to understand with it moving every single second, how can we identify where it can go the next day, 2 days from now, a week from now, a month from now? How can we identify that? We're going to go through that right now with the chart breakdown. With the chart breakdown, you're checking the monthly for the overall momentum, meaning the higher the time frame, right? The higher the time frame, the bigger the move. So when you're checking the monthly, you're just looking at it for the perspective and the bias of where can it go long term? Can this market move down in a downtrend for the next 3 months, or can it move in an uptrend in the next 3 months? Or is this market going to consolidate for the next 3 months? Right? So you're just checking the monthly for the momentum. You check the weekly for the swing high and swing low, right? Because now when we go down to the weekly, we get to see a little bit more of the breakdown of how they're moving the money each week throughout the months, throughout the year. So with the weekly, you want to check the swing high and swing low between, above and below where price is now. So anytime you're looking for a setup, you're analyzing from where price is now based off where price was before and where price can potentially go. So the swing high and swing low, you look for that between, right? So if we're looking at GA, right, look how large these candles are. We noticed we had a big move in March when the coronavirus happened, right? A big spike up and then a big move down for the next 1, 2, 3 months. And then we've been consolidating for the past 6 months, right? So with everything that we're seeing here, we can see that on the monthly time frame, we're moving bearish, we're moving downward, right? So now we check the weekly for the swing high and swing low. So we go down to the weekly. Where's the nearest high, which is right here, right? Where's the nearest high, which is right here, right? Nearest high, and then our nearest low is right here. So we found our swing high and our swing low. So now we know that the market has to break one of these 2 points for us to identify if the market will continue to go lower or continue to go higher, right? We check the daily for the major range. So now when we go down to the daily, we're technically kind of looking for the same thing. Where's that recent, high to low point? So now being an intraday trader, the daily and anytime, being an intraday trader, you want to check from the daily and down. So the daily 4 hour, 2 hour, 1 hour, 30 minute, 15 minute, 5 minute is your best friend. Being an intraday trader, right? It allows you to understand that the market comes back to previous daily highs and previous daily lows. That's the schematic of the market. It creates liquidity and generates money when it leaves a high or a low point, right? So think about the market in the game of seek and destroy. The market is creating these highs and lows and coming back to them to crash them because there's a lot of money sitting below or above, right? So we have our high point, we have our low point, and then we have these sub high points. And then we have this sub low point, and then we have the overall low point, right? So now the 4 hour, we're looking for breaks of structure, the 4 hour vision. Now the 4 hour, right? So the daily can help us look for overall trends that can happen over a course of a week, right? And the 4 hour now helps us understand how the market will potentially move over the course of that week, or set amount of days based on the structure of the movement, right? The 4 hour now is where we see the clear indication of a trend, where we're actually seeing, either lower lows, lower highs, lower lows, lower highs, or if we're seeing higher highs, higher lows, higher high, higher lows, higher high, right? That's what I'm going to, tonight. So we're tracking the 4 hour for breaks of structure. We track the 1 hour for that day's momentum, right? And I'm gonna go into all of this later. So there's something called the session breaks. The session breaks allows you to see the breakdown of how the market is moving between each day, how they are setting these daily lows and daily high points, and how they are, you know, based off the volume of the market price, whether it's, going down or going up. The 1 hour will show you the potential direction in that moment within a few hours to help you get an entry into the market. So the 1 hour helps you track the daily momentum. So we can see that on this day, the market shot up and came right back to where it opened up at. And then in the next day, it opened up around the same area of the previous day, shot up, came back, and continued higher. So now we can see that we created a higher high, higher low, a higher high because we broke these highs, and we created a higher low because it never broke these lows. Continued higher, higher high, higher low, higher high, higher low, higher high. So as you can see throughout 3 day span, we can see that the market showed us on the 1 hour momentum for buys, right? So the 1 hour will show us the transitions of trends and the momentum of the potential trend, right? So now we have the 15 and 5 minute. The 15 and 5 minute, right, helps us identify entries, So we use the 15 and 5 minute for entry points, right? 15 and 5 minute for entries. So when it comes to that, when we identify a potential trend, the 15 and 5 minute helps us find optimal setups, right? Setups that will give us the best return on our investment. So as we can see, right, just for an example, the market broke these lows right here and created new lows. So that is an indication of a downtrend. So when the market came back at this point right here on the 15 minute, we can see that it retested those broken lows precisely, giving us a little to no drawdown entry to continue going lower. So these are the types of things that we are going to be trained to capitalize on by enhancing our language towards this market, because there's a misinterpretation and a misconception of what it means to be a trader, or just what it means to learn how to trade. You just need to take the time. Simple, right? So that's your chart breakdown. Now, identifying targets, right? Identifying targets. So what are we looking for? We always identify targets before entries, because if we don't identify where the market can go, which is a target, we don't know how to be able to enter, right? So what are we looking for? We're looking for the trap money candle. That trap money candle can come in a shape as a last up candle before the down move, or a last down candle before the up move, or a bullish or bearish engulfing. Right, so a trap money candle is considered one of these two things on the bullish or bearish ends, right? So an example of that. I can always remark this out. Right, so notice something. The market is based off of a concept called smart money bank trading. And it helps us be more aware of how the market can be manipulated based off of the position of where the market is and what's going on with potential news events, right? So trading is based off of price and time, price, time, and positioning, right? So we identify trap money candles as those last candles before a big move. And what do I mean by that? Notice how we have this up candle, right? This candle, the black candles represent up, white candles go down. So we have this black candle, it shot price up and stuck it in there. And then price had broke down below that candle. And when the market came back to that specific candle, it reacted and gave us another selling opportunity. And what this does is this gives us opportunities to wait for the most next potential optimal setup in a sense of understanding what it means, in a sense of understanding what these candlesticks mean, right? What do these candlesticks mean? These candlesticks represent money. And the people that control this market, they form these candlesticks based off how much money they want to move within that day. So daily orders are filled to achieve certain price points every day. And these candlesticks represent those price points that we can potentially see and predict the market coming to, so we can find our own positions, so we can make our own money. So a trap money candle is defined by the last candle before a big move. So this was the last up candle before the down move, and then the opposite for a bullish trend. We have the last down candle, right? The last down candle before the up move. So we got, the last down candle. We got the last up candle, right? So the concept is understanding that the market traps people in the opposite direction so they can go in the intended direction. So they would shift the market higher to go lower, or shift the market lower to go higher. And then essentially they create what you call an engulfing pattern. Not all the time, but sometimes, right? Where they would shift the market lower, and then the next candle would be a bigger bullish candle, which would engulf. So we want to see that next potential candle bigger than the previous one, or, right? Or we want to see a break back above that candlestick, as in this one right here. Because notice we didn't have a big bullish candle on the next one, but what we did have was a break above the candle to give us confirmation to take it for a buy. So once again, we just want to learn the targets. The targets is what helps us identify entries, right? We got another one right here, right? So the last up candle before the down move, and the last down candle before the up move, right? So these are the potential targets, and the same thing potentially for a bearish move, because notice, right, we're identifying this up candle, right? This up candle, down move, and then retest. We created what? A bearish engulfing. A bearish engulfing would be that next candle is bigger than the previous candle. So an engulfing candle is created either at a high or a low point. So if it's created at a high, that means we have a bearish engulfing, meaning we have a downtrend potentially forming. If we have a bullish engulfing happening at the low, that means we have a potential uptrend forming. So as long as we have our bigger bias in mind and our potential understanding of where the market can go overall, then when we read these things from a daily perspective and then break it down to the 4 hour, everything becomes a lot more clear, right? Everything becomes a lot more clear because now, once we identify these targets, we have to wait for these targets to be hit. And waiting for these targets is the biggest killer to every trader because we want the money now. We want the money now. It's cool to have the money now, but just imagine waiting 2-3 days for a setup that can give you everything that you was waiting for, plus everything that you potentially could work for, right? In a matter of 2 to 3 days. So being patient pays. Patience pays because paying attention is patience, right? So pay attention because attention pays, right? So once again, patience, patience. If you're paying attention and having patience, you can wait for these types of things to happen for you, right? So now you want to identify equal highs and equal lows, right? And what do I mean by equal highs and equal lows? Points in the market where they are creating a sideways movement, which forces the market, right, to create a equal high, relatively equal high point, or a relatively equal low point, right? And it creating money at these highs and lows, right? So we have equal highs right here, right? Rejection, rejection. So equal highs and equal lows can be formed at rejection areas, right? 1, 2, 3, right? Rejection, 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 right? Rejection, rejection. So essentially, these equal highs and equal low points are created in what you call consolidation. So you have your trending markets and consolidating markets, right? Equal highs, equal lows. And here's why we look for equal highs and equal low points. Right? Equal highs, equal lows, right? The reason why we look for these is because there's money sitting above these levels. There's money sitting above these levels. And the market comes to these levels to grab money and literally clear the range. So they set a high point of a range, they set a low point of the range, and then they literally clear both ends. to refill new orders and go the opposite way. All right. There's money sitting at these levels right here. All right. They literally run you out the market. Like I said, seek and destroy. They run you out the market. All right. They create these equal points, equal point, run the high to run the low, or run the low to run the high. So the market is a schematic of playing seek and destroy. And as long as you can understand this, like everything will be so simple for you. All right, everything will add up. And once again, you will start identifying these things when you start realizing, number one, where the trend is going, and number two, if you can spot a reversal happening. So it can help you identify a trend or spot a reversal. Right. So those are your targets, right? Now, the last target that we're looking for are price imbalances. What is a price imbalance? A price imbalance is equivalent to a gap in the market. It's an area where there is a big void that was created in the market with inside of a candle, right? And the way you measure that is by looking at the candle itself and noticing that there's a big void in the candlestick. By a big void, there was no retest. Every point of price has to be filled in, meaning when they create big moves, they have to come back and retrace and retest all of this money that was given out. That way they can continue moving in the intended direction. That's how we understand where the trend is going, by them making big moves and them coming back most of those big moves, right? So an imbalance is an area in where price created a void, which is an open money spot. So every target is an open money spot. So we have a big void here, and we have a big void, and we have a void right here. So we can find imbalances on every time frame. So the time frame I like to look for my imbalances for is on the daily and the 4 hour, right? The 4 hour, you can see imbalances, just a little bit more clearly, right? And the whole idea of an imbalance is just for price to come and fill it in, right? Price wants to come and fill in, right? Notice this large candle, right? From the previous candle, right? From the candle before it and the candle after it, you're measuring the points of the low and the high of those candles, right? And you're covering the gap of that candlestick. And as you can see, just by a quick example, the market came in and filled price in, and you were able to take a sell opportunity to take price lower, right? So once again, these are just intraday, these are just tactics and targets that you can practice to identify potential open money spots for you to find a entry in the desired position. That is it, right? And this is a consistent system when you follow it. So this is what you consider a sell imbalance, and a buy imbalance is just the opposite. A buy imbalance is literally the opposite. So notice right here, notice this large candle right here, right? And from this point of this candlestick, from the high of that candlestick and the low of this candlestick, is the void of that candlestick that I will be measuring. That will be measuring. And when we're looking for a retest, we're looking for price to come and fill it in. Sometimes it doesn't always fill it in all the way, but we're looking for price to come and retest inside of that zone. So we have buy imbalances and we have sell imbalances. So just real quick, drop a 2 in the chat for me if you guys are following along. Drop a 2 in the chat. Does anybody have any questions? Any questions real quick? I know E sent me a chart. Just look at it real quick. GA. Okay. I can see that big fella. Imbalance right here on the 1 hour. We got that last trap money candle right here. Okay. I can see that. I can see that. Right. So those are all the targets that you literally want to look for on every time frame, and you can find them on every time frame. Right. Every time frame. So what I do every single day, I look for these targets on every time frame, on every single chart, on every single chart. And the higher the time frame that I can find one of these targets, the less I will have to mark up my chart. Here's why. Because if I have an overall target, that means I'm looking for a bigger move. If I'm looking for a bigger move, that means I can track the trend of how to look for that bigger move. So with that being said, here are the confirmations for you, right? Market structure, 3 main confirmations. First confirmation is market structure. Within market structure, we have consolidation, and which is sideways movement. We have an uptrend, which consists of higher highs and higher lows. We have a downtrend, which consists of lower lows and lower highs. So we have a consolidating market, a trending market, and a reversing market, which consists of head and shoulders, M's and W's. Second confirmation is price action, which I will go over tomorrow. Price action consists of the open, high, low, close of a candlestick, right? And whole, half, and quarter levels. Third confirmation is smart money. Smart money ties into looking for that trap money candle, right? Where the market is trapping people. Smart money is a concept of buying to sell and selling to buy, because the market has to buy up to sell off and sell off to buy up. So just tonight, I will go over 3 types of market conditions, right? First market condition is consolidation. Consolidation creates structure, right? Consolidation creates structure. Think about it like this. When you are warming up, that's not a whole workout. Warming up, you're getting your muscles tight and ready for your actual warm up, right? So you're shortening, right? You're shortening and you're packing everything into one quick warm up to let your body explode for the actual workout. So that's the same way that the market works in consolidation. Consolidation is the sideways movement, right? Consolidation is the sideways movement. Literally, the market is trapped in between the same high and low point, right? Trapped in between the same high and low point. Consolidation. Consolidation creates structure. Choppy market conditions ranging between the same high and low point, trapping the market. Here's why consolidation creates structure. Because consolidation creates the trend. And by a trend, we have an impulsive move with a correction. So in a buying trend, buying structure consists of higher highs and higher lows, where we break highs, make new ones, and we retest the previous highs to continue higher, right? How does that make sense, right? So here's one thing that you guys can take away. I'm about to pull this up right now. When it comes to pattern recognition, you want to remember these phrases. After a big drop, the market must chop. After 3 days of drop, the market must chop. After a big rise, the market needs more guys. After 3 days of rise, the market needs more guys. Realize the consistency in two of these statements. 3, right? 3 days of drop, 3 days of rise. The market moves in threes. The market moves in threes. 3 levels up, 3 levels down. 3 levels up, 3 levels down. When you understand this, it will make everything a lot more simpler for you in your trading journey. The market moves in 3 waves. The market moves in 2 to 3 waves. 3 waves up, 3 waves down. In a correction, which is consolidation, right, creates the 2 waves, but in a trend creates 3 waves. So here's how we about to break this down. This market downtrended. This was a low, this was a lower high, because this high was still lower than this high. But this was a higher low point because this low was higher than this low. So now when the market pushed higher, guess what? It created a higher high. So now we notice that the market shifted in momentum to go upwards. So now I will consider this my starting point, right? This is my first high. After a higher high, what do we get? A higher low. Boom. After a higher low, what do we create? A higher high point. That's the second wave. So we have we have the starting point, which is 0. First wave up is 1. The pullback, which is the correction and consolidation, right? So the correction is consolidation. A correction is consolidation. And then we have the second wave to the third point. The third point to the fourth point is the next higher low, right? So we create highs, breaking old ones, and we retest those previous highs that were broken as a higher low to create a higher high. Create a new high, pull back, retest the previous high that was broken, continue higher. And we just created a 3-wave pattern, a 3-wave push to the high. So now in between that, right, in between that, what do we have? Consolidation. The market ranging between the same highs and lows, right? The same highs and lows. Market is choppy. So when we can identify our trend, how big, obviously, can you see that helps when you're looking for the next potential move, right? When you can notice your trend, then you can notice how you can identify a buying structure so that way you can catch the next potential move, right? Broke structure, right? Broke this high right here, retested it, went higher. So once again, this is buying structure. And in between, right, we have consolidation. Right, equal high points, relatively equal highs, equal lows. Well, we can move this one a little bit higher to match it up. Either way, you guys get the point. They're creating what you call liquidity. They're generating money to fake people out, clear them. Because as you can see, they went higher, but look what they did before they went higher. They cleared out some lows, went high, cleared some highs, came back lower one last time before pushing higher, right? This is the game. Noticing the structure and noticing how they're creating the structure. So that way you can find the lowest risk possible, right? So now notice how the market, right? So that's a buying structure. Selling structure. What's selling structure? Right? Lower lows, lower highs. We break lows to make new ones, retesting previous broken low to continue lower. So just like when we create new highs, right? We break highs, make new ones, and then we retest previous highs to go higher. Opposite for a sell. We break lows to make new ones, retesting previous low to continue lower, right? And that just consists of another 3-wave push. That consists of another 3-wave push, right? We have our low, right? Lower high, lower low, lower high, lower low. 3 waves. Look what the market did. It came right back. Came right back. Basic stuff. So this is the basics of what's going to help you identify market conditions, your market structure. Market structure is king. Price action is key. Smart money is the way, right? 3-level rise, 3-level drop, right? 3-level rise, 3-level drop. When there's a big rise, the market needs more guys, so it got to pull back. After a big drop, the market must chop, drop, chop, right? Market rise, it needs more guys. These are things, these are concepts, right? So the great thing to help you identify market structure is exactly what I'm about to show you right now. Right, the Forex Chart Anatomy PDF. This is golden. Right, this is golden. This is something that you want to study because this is literally what I just showed you. So notice the market stages. We have the beginning of the cycle, which is the accumulation, working its way up to distribution, right? So we have demand zones at a low, supply zones at a high. And what do? Buy low, sell high. Cycle starts all over again. So literally, the market is a cycle, it has a schematic, distribution schematic. This is what you're looking for at high points. This is what you're looking for at sells. This is the schematic that will be tied into looking for entries when I go over that Thursday and Friday, right? So I'm going over market structure now. Tomorrow I'll be going over price action. Wednesday, smart money. Thursday and Friday, identifying optimal elite entries, right? So this schematic is going to come into play a lot, and market stages and market cycles just has to deal with market structure in general, consolidation and trends and reverses. And then you have your chart patterns that you can study to help you identify your corrections for your continuations, right? So you have the big move up right here, or you have a bullish flag, continuation pattern, impulse up, corrective wave down, go higher, right? Even sometimes you can see the market potentially, sometimes you can see the market go in a downtrend, but will continue higher, right? We go in a slight uptrend, but we'll continue lower. That's all we have to identify our trend. So I personally only look for chart patterns on the 15-minute. I only look for chart patterns on the 15-minute. And I will go into that more deeper when it comes to looking for entries. And then you just have more confirmation. So this is your study guide, chart patterns. And this right here will help you with your determining your lot sizes. So always remember your lot 5% risk, 3 to 5% risk per trade, right? At least 25% of your account per day to risk. And your stop loss determines your lot size. So you want to go over the Forex chart anatomy. You want to read the market maker method and the candlestick trading Bible. Right, candlestick trading Bible. So these are the things that's going to help you tie into everything that I'm talking about. So now we have a reversing market. I'm almost finished up. I'm almost done. Just want to be able to just get this out. Right, so we got the reversing market. In a reversing market, right? That's where they design these market patterns, right? The M's, W's, head and shoulders. Designing market patterns to influence a push in the opposite direction. When looking for reversals, they typically form M's and W's, head and shoulders, right? Inverse head and shoulders, which is the expansion move, which what we are looking for is called the dummy move. Happens when they cleared a previous high or low and then reversing the market. In a selling structure, and typically in a selling structure, they create the M first, then create the W to break the M and reverse to initiate the sell. So how is that possible? So as you can see, we had an uptrend and then we shifted into a downtrend. Let's notice how they created the M's and the W's and the head and shoulders that initiated this, reversal in the market. So as we can see, the market created some lows right here, a nice W formation, and then it came and created a nice M formation. So what did the market do? It created what? Equal lows, relatively equal lows, right? Relatively equal highs, right? So they literally created the W, created the M, and then cleared the W, and then went lower, right? So they will set the market up. And also on the back end, they created what you would call a head and shoulders. You have a high, they pulled back, created a new high, and then pulled back, and then retested the previous high over here, and then gave the drop for the right shoulder. Gave the drop for the right shoulder. Let me see this chart real quick. GCAD, jeez. Yeah. Yeah, GCAD. I like that move. Right, so that happens at highs. Right, that happens at highs. You have a regular head and shoulder, and then you have a M to finish it off, right? They clear the range. They clear the range before making the move. So in a reversal for a buy, you could potentially look for the same type of structure, right? The market shifted, came lower, pulled back, created another low, came back inside, higher low, higher high, higher low, went higher, right? What did they do in here? They created an inverted head and shoulders, right? Right shoulder, take the market higher, right? So literally, we're just being patient when we see the market hit one of our targets and we're potentially waiting for a setup. So that is market structure. That's market structure. Right? You have three types of market conditions: consolidation, trending, and reversing. And for each um, condition, it has a story that is telling that allows you to see the flow of the market, right? So like I said, that was selling structure and buying structure. They create the W first, then create the M, break the W and reverse to initiate the buy. This is the run on liquidity, the stop point runs where they're taking people's stop losses. They're wiping the board to go in the intended direction, achieving a higher or lower objective, right? So that's literally the basis of market structure. Everything that you would need to understand how to read it. So with all of that being said, I'm going to just stay on here a little bit longer and mark up my chart because I know there's some setups happening right now. I know there's some setups happening right now. And all I know is GA left the building. Sheesh, GA left the building. That's the move. GA left the building. I'm about to stop recording.